Good morning, and thank you everyone for having us here today. Before I get started in introducing our first speaker, Melinda is going to put me to work here. So she asked me to please ask everyone to kick off the morning with a question, as we did yesterday. We'd be curious to hear your thoughts about, over the next 6 months, the retail's biggest sector, biggest challenge globally will be, you can see the choices there in front of you, and if we can pull out our cell phones and actively text to 2233, will be consumer confidence, environmental disasters, global political conflicts, governmental regulations, inflation, unemployment, or none of the above. If it's not any of those above, I'm scared to know what it might be. All right, we'll see the results here in just a minute. Everybody's got to wake up and start texting quickly this morning. Consumer confidence, wow, by a wide margin, and inflation up, but quickly catching up. It's like a horse race. Super. Oh, they're still coming in. Slower texters. Clearly not the early adopters of the tech. None of the students aren't here. Not as many students today, so we're a little slower. Well, there's clearly more than 83 people here, so. Okay, well, very interesting perspective that consumer confidence will continue to be the biggest challenge. And when Ira gets up in just a minute, I'm sure he's going to address some of that. I am pleased to introduce Dr. Ira Kalish, the Director of Economic Research for Deloitte. But before I do that, I did want to say that Deloitte Consulting is proud to be a sponsor for the 5th year in a row of both the Terry J. Lundgren Center for Retailing and the Global Retail Conference. As a firm, we are deeply committed to programs like this that are developing the next generation of business leadership and talent. Many organizations, and many of your organizations, will frequently say that people are our biggest asset. Well, the truth is, in an organization like ours, people and their ideas and their innovative thinking are our only asset. And so we are always interested, keenly interested in seeing programs like this grow and thrive to develop future talent that we can also take advantage of to serve clients like yourselves. So one of the most significant factors, I think, as you saw, besides consumer confidence, was the economy. And obviously, that's an important factor for all of us going forward in the near future and probably the longer-term future, as some of the things you'll see in a minute will indicate. We're pleased to have Ira here with us today to share some of his perspectives, not only on the U.S. economy, but on the global economy, because after all, this is the Global Retailing Conference. Ira is a recognized expert on global economic issues, as well as the effects of economic, demographic, and social trends on retailing and consumer product industries. He's a regular speaker at events like this. I thank him. He flew in yesterday from the UK, where he was speaking in another conference and meeting with some of our clients, and on Monday he's off to Hong Kong to do the same. So I appreciate him being here for us today. He is also a regular speaker at the NRF Big Show every year, where he launches our annual Global Powers of Retail study. He's also someone that I turn to on a regular basis to sharing economic insights with our clients in all of my practice so that they're well-versed on the things that are happening out there and share some of his expertise. So please welcome my good friend, Dr. Ira Kalish.
Thanks. Okay, good morning. Thank you for having me here. I saw the results of your survey, and you got it wrong, so I'll give you the right answer. So I'm going to talk about the global economy and the impact it has on consumers and therefore on the retailing industry, both here in the U.S. and especially in emerging markets, which I think will be of critical importance to the industry going forward. But before we talk about the future, it's worthwhile talking about the past and how we got to where we are. And over the past decade, we had a pretty good run. We had very strong consumer spending growth here in the U.S. and in the UK and Spain and a number of other countries. And that was really fueled by debt related to the housing market. If you look at this chart, which is one I especially like because it goes back 120 years, it shows the real or inflation-adjusted average price of houses in the U.S. over the last 100 years. You can see that for about a century, house prices were pretty steady, and then they went through the roof. And then, of course, they collapsed. But one reason they went through the roof is that we had a massive amount of liquidity coming into the U.S. from China. China was intervening in currency markets to hold down its currency. In the course of doing that, they flooded us with liquidity, put downward pressure on our interest rates, fueled the housing bubble, enabled American consumers to borrow a lot against the value of their homes and spend with abandon buying products made in China. So it was a pretty good situation until it wasn't. And it wasn't over the past 3 years because that housing bubble collapsed. It led to a loss of wealth for consumers. It led to a near collapse of the global financial system. Fortunately, governments around the world responded quite quickly, but we still had a very deep recession. And it started the process by which consumers are now deleveraging and will continue to deleverage, and that has negative consequences for consumer spending and for retailers here in the U.S. And conversely, it means positive news for consumers and retailers in China, which is moving in an opposite direction. So, excuse me, we're going to have in the coming decade an unwinding of the big imbalance that we developed over the past decade. And that means that here in the U.S., more of our economic growth will come from exports and business investment rather than consumer spending, which will decline as a share of GDP. And on the other side of the world, China will move in the opposite direction, because the Chinese cannot in the future grow as fast as they did in the past by simply making consumer products for U.S. consumers, because that market simply won't be there. So China has to shift toward an economy based on their own consumer demand rather than exports, and that will be beneficial to retailers that operate in China. We'll see the dollar continue to fall against emerging market currencies, and that will help to grease the wheels of transition to this kind of new global economy, and that will mean more of a middle-class consumer culture in emerging markets will emerge, and that will change the structure of the global economy. So that's sort of the history of the last 10 years and the next 10 years in a nutshell. Let's move on to some of the details and look first at the U.S. Right now, we're in an economic recovery. This year, we'll see pretty decent growth for a number of reasons. Already, we have an uptick in consumer spending. We've had the QE2 policy of the Federal Reserve. That's the second round of quantitative easing, where the Fed is putting downward pressure on real interest rates in order to kickstart the credit markets. We had the tax deal, whereby payroll taxes were cut, and that mainly affects lower to middle income consumers who are very likely to spend that money, unlike more affluent consumers. We've already had very strong growth of exports and investment, and as you can see in this chart, real income is starting to accelerate from a very poor level down to up to a more moderate level. So the outlook isn't bad. We're going to have decent growth this year, not great growth. We'll have low inflation, and even though commodity prices are rising, retailers really won't have the ability to pass those prices on to consumers to the extent that they want. So we'll see retail margins getting squeezed a bit, and indeed, we're already seeing that. Longer term, as I said, we're going to see our economy shift away from consumer orientation. Right now, consumer spending is about 70% of GDP. Historically, it was in the range of 65 or 66%. I think in the next 10 years, that's where we'll go, which means consumer spending will grow slower than the economy, and exports will grow faster than the economy and contribute more to our overall economic growth. We're going to see, when QE2 policy stops, we'll probably see an increase in interest rates. In the next decade, we'll probably see an increase in taxes to deal with some of the demographic issues we have. So we're going to have a very different kind of economy here that will have some negative consequences for retailers. Now let me talk about really long term and what this means for retailers in terms of income distribution. If you look at this chart, this shows two bars, the light-colored bar and the dark-colored bar. Let's look at the light-colored one first. This is the real average household income growth from 1947 to 1973 for different income groups, the bottom 20%, the next 20, all the way up to the top 20 and the top 5%. So we're looking at how income is distributed. And in the period prior to 1973, every income group experienced strong income growth. After that, in the period from 73 to 2005, which is the darker bar, we had slower overall growth of personal income, but most of the gains accrued to upper income households. Almost none of the gains to lower income households. Those people saw very stagnant real wages. Now, why was that? Well, because there was a supply-demand imbalance in the labor market. in the 70s and 80s, this was the time when globalization and investment in information technology changed the needs of the labor market. We needed more skilled people. We needed fewer unskilled people. And yet, we were supplying a different range of skills. This chart shows the average years of schooling by year of birth, going back to the 1880s. I like these long-term charts. And as you can see, that up until about the time when people were born in 1950, we were very rapidly increasing the average education level of our workforce. Then starting with people born in about 1950, that is, people who would have started school in maybe 1970, we stopped accelerating education for whatever reason. I'm not sure. It's instructive that in the past 30 years, the number of people who started college increased dramatically, but the number of people finishing college didn't increase at all. So we stopped supplying more skilled workers right at the time when we needed more skilled workers. And that led to big increases in wages for the highly skilled and the upper income groups, and downward pressure on wages for everybody else. And that's why we've had this skewing of income distribution in the US. But the interesting thing is that in the past decade, we were able to get around this by borrowing. Now, I'm not going to show too many complicated charts, but please bear with me. This shows, the blue line shows for each of these years in the past decade, the amount of cash that Americans extracted from their homes, either through home equity loans or getting extra cash when they refinanced their mortgages. The green line shows the increase in consumer spending in the US each year. The lines are almost equal almost every year. In other words, just about all of the increase in consumer spending in the past decade was funded by people taking money through their homes. And the important point is that's now over. So during that period, lower and middle income households whose incomes weren't rising were able to increase their spending by taking on debt. Now we're going to pay the consequences for that. Going forward, the housing market will be very poor, and the real incomes of lower and middle income households will continue to stagnate, and that means we're going to have a very different retail environment. It means that the preponderance of increase in spending will come from upper income households, and lower income households will be very constrained and obviously therefore more price sensitive. So we're in a new economic environment, and consumers are already starting to deleverage from this situation. This chart shows the debt service payments people make as a share of their disposable income. It was rising a lot for the past 15 years, and then in the past 2 years it started dropping precipitously as people started paying down debts, as people were forced to tear up their credit cards. And the good thing about this is it gives people a little bit more cash flow, which means that maybe in the coming year there could be a bit more spending to deal with some of the pent-up demand. But going forward, people won't be able to use their homes as ATMs anymore. And so household spending will be constrained by household income, which is kind of a novel concept for us. And that's going to be a problem, and it's going to have a big impact on the retailing industry. And of course, the housing market continues to suck, for loss of a better word. As you can see, housing starts dropped dramatically and are now steady at a very low level. There's a huge excess inventory of unsold homes. There's continuing downward pressure on home prices, and a quarter of all people with mortgages are underwater, which means that the mortgage debt they owe is greater than the current value of their home, which means it's difficult for them to move, to get a new job. It's difficult for them to do anything, and there's a lot of pressure on them to continue to deleverage, pay down debts, and add to their savings. And in a state like Nevada, 70% of people are underwater. And then there's the job market. I'm telling you all the bad news first, okay? The job market also is not in great shape. If you look at this chart, you can see the trajectory of employment during and after all the recessions of the post-war era. And most of them have that pattern where they go down very quickly and then jobs come back quickly. Because in the old days, when we had recessions, companies, factories would lay off workers temporarily, and then when the economy came back, those workers were rehired to the same jobs, and employment rebounded very quickly. That's not the way the world works anymore. In the three most recent recessions, that long black line, the long brown line, and the red line down on the bottom, which is the most recent one, we had very slow growth of employment after the end of a recession because of the restructuring of the economy. In the current case, which is that long red line, 40% of the jobs that were lost were in construction. Many other jobs were in related industries, right, like real estate and financial services. And those jobs aren't coming back. We're not going to see a rebound in housing and construction in general anytime soon. Moreover, those construction workers will not be easy to reemploy doing other things. They don't have the skills. So we're going to see fairly slow job growth going forward. It's going to take a long time to get back to where we were, and this is one of the factors that is slowing the economic recovery. Although the good news is there are some signs of improvement, of acceleration right now in the job market. And the other interesting thing about the job market is that it seems to be bifurcated the way our income distribution is. Again, we have very strong demand for highly skilled workers, very limited demand for those without skills. And it shows up here. The unemployment rate among college graduates is only 4.5%. The unemployment rate among high school dropouts is about 15%. So we're seeing that bifurcation, and that's going to have an impact on where the income will be and who will have the income to spend over the next decade. So what does this mean for retailing? Well, for retailing, it means increased bifurcation. It means we'll have some retailers who are very focused on price and volume and appeal to that lower to middle income consumer whose income is not rising and who's very price sensitive and very constrained in what they can spend. That's companies like Walmart, for example. And then we'll have the upper income households who have money to spend, whose incomes will rise, who will be more focused on brand and differentiation. That's companies like Whole Foods, for example. So we're going to have this bifurcation, and it will also probably entail some shakeout in the retail industry through merger and acquisition and through bankruptcy. And it means that the overall retail industry will grow fairly slowly because consumer spending growth will be slower than the overall economy as our economy shifts more toward export-oriented growth. And so for retailers and their suppliers, more potential growth will exist overseas. And I think we'll see more American retailers invest in other markets in order to take advantage of that factor. So that leads me to China. And let's talk about the rest of the world and what's happening and what it means for retailing. Well, what happened recently in China? They also suffered from the global recession, although they didn't have a recession themselves. When their exports collapsed, 20 million Chinese workers lost their jobs. Most of those were migrant workers working in factories in the big coastal cities, and many of them went home to their ancestral villages. And then the government had a massive stimulus program which got the economy moving very quickly, and consumer demand grew very quickly. And then the economy was in pretty good shape so quickly that it started to overheat with inflation, with increases in property prices. And so in the past year, the government tightened monetary policy by raising interest rates in order to slow down the economy, which was successful. You can see they slowed down to about 9.5% growth. They consider that slow in China. And so that's the situation as it stands now. But the interesting thing is that through all the turmoil, retail sales never skipped a beat. The dotted line shows the percent change year over year in retail spending. And as of December, it was up 18% year over year. Now, if you subtract out about 5% inflation, that means real growth of retail sales of about 13% year over year. That's very significant, and it hasn't dropped, and it's not likely to drop. And it shows that China is already shifting from export-oriented growth toward consumer-driven growth, which is a very good thing from a retail perspective. But there are other issues facing China, one of which is demographics. As you can see here, up until now, the labor force, the blue line, has been growing faster than the population, the red line. That's the percent change of each of these things. And the good thing about having the labor force grow faster is there's been an abundance of labor, there's been downward pressure on wages. It means that the dependency ratio has been declining. There's no need to worry about paying for the retirees because they're dropping as a share of the population during that period. And it meant fairly strong economic growth. However, going forward, and this is due to the lagged effects of the one-child policy, the labor force will grow more slowly and actually stop growing by the end of this decade. And with a slower growing labor force, that means a tighter labor market, more upward pressure on wages. It means potentially slower economic growth overall unless China can accelerate their productivity growth. It also means that India might grow faster than China because India has different demographics than China does. So one of the things, as I said, that this means is upward pressure on wages, and we're already starting to see that. This is the average monthly wage of a worker in a shoe factory in Dongguan in southern China. And you can see that for a long time the wages were fairly steady, started to rise, and are now rising very precipitously. Why? Because of that shortage of labor, and also because of a change in internal migration patterns. People are not migrating from the farms to the cities in as big numbers as they used to. And when they do, they're demanding higher wages and better working conditions, and local governments are dramatically increasing minimum wages to accommodate them. So this is going to lead to a very different economic structure for China. It means that in addition to having a gradual appreciation of the currency, we're going to see a shift of low-wage workers into the interior of China or to other low-wage countries like Vietnam and India. We're going to see higher value-added processes take place in the big coastal cities, more services rather than manufacturing, and more focus on the needs of the domestic market. And as factory workers' wages increase a lot, they will join the ranks of the middle class and form the basis for continued modernization of the retailing industry. So this is all good, actually, although the transition involves a lot of pain and could involve a lot of social unrest. But as this transition takes place, China will be a more attractive consumer market. And as you can see, in recent years, consumer spending in China declined dramatically as a share of GDP. This can't go on. They're now down at about 34%, as opposed to 70% in the US. It's likely that in the coming decade, this will go back up. There are still some remaining problems, and it's not going to happen right away, but I think in the longer term, we're going to see more consumer spending growth in China as the currency rises in value, suppressing import prices, improving the purchasing power of Chinese consumers, and as the Chinese government does things to improve the social safety net, thereby forcing consumers to spend more and save less. Now, consumer attitudes are kind of conflicted. On the one hand, they're very frugal and price-driven, but on the other hand, they're very brand-conscious. So retailers will have to take these factors into account. And what about Chinese retailing? Well, it's had a good run for the past 20 years. It grew very rapidly. Modern retail formats dramatically increased their share of total retail sales. There's been a lot of foreign investment in the big coastal cities, especially in food retailing, by companies like Walmart and Carrefour, and increasingly now in those cities where there's a rising middle class and a rising affluent class, we're seeing more investment by non-food retailers, including luxury retailers. So then the question is, why did I show these two pictures? Well, these are pictures from inside the largest mall in China, the South China Mall in Dongguan, which was built about 6 years ago. It has 7 million square feet of selling space, as opposed to the Mall of America in Minneapolis, which has a little over 2 million square feet of selling space. So it gives you an idea of how big it is. It has a full-scale replica of the Arc de Triomphe. It has canals with Venetian gondoliers. It has an amusement park and an indoor wave pool, as you can see. But the really interesting thing about the South China Mall is that it's 98% unoccupied and has been for 6 years. Because Dongguan, the city where they are, is a city of factory workers who have almost no money. Most of the money they have, they send home to their parents on the farm. Why anybody thought these shoppers would go to that mall, I don't know. But you can see on the bottom picture, it's largely empty and falling apart. So the mall developer sold it to Beijing University. Apparently universities there like to invest in property. And they decided, I hope that your university doesn't, they decided the way to deal with the problems of the South China Mall, as you would expect, would be to expand. So I'm not kidding. They're going to build 400,000 more square feet of selling space. I don't think they've learned the rules of supply and demand yet. But in any event, this is kind of emblematic of what has happened in Chinese retail. They have overbuilt terribly to the point where something like this can't make any money. And that has economic consequences because China continues to overbuild not just shopping malls, but everything else. And ultimately, something's going to happen. There could be a financial crisis and a lot of bad assets on the books of the Chinese banks. So there is a risk over the next couple of years that China could have a backlash because of this that would lead to much slower economic growth temporarily. They need to restructure their economy away from this kind of overbuilding. The good news is that for retailers who are looking for space, there's plenty of it available. Now let me talk about India. India is on a very strong growth path right now. They have grown quite rapidly in the last few years, probably faster than they can. That's why the economy started to overheat and there's a little bit of inflation. The interesting thing is that a lot of the growth now is based on manufactured exports, not so much on call centers and other offshore professional services. They are becoming a major manufacturing base. And as China moves up the value chain, and doesn't do all the low value-added apparel and textile and footwear manufacturing, a lot of that, I think, will shift to India, where wages are still very low. So India's outlook is pretty good. On the other hand, the consumer market is very different than in China. Consumer spending is a much higher share of GDP. It's come down a little bit. It's not likely to go up much further. So in China, even though economic growth is going to slow, retail spending will accelerate because it's going to increase its share of the overall economy. Unlike in India, where the economy will probably grow faster, but we're not going to see a bigger share going to consumers. But in any event, the consumer market there looks to be quite promising. And one reason is the very favorable demographics. If you look at the various population levels, the working age population is expected to increase much faster than other populations, which means there'll be a declining dependency ratio, a larger pool of workers, downward pressure on wages, faster economic growth, and the rise of a middle-class shopping retail market. So that's all very good. But what about the retailing industry in India? Well, we've seen a lot of modernization lately. 10 years ago, only 3% of retailing in India could be considered modern. Today, it's about 15%. Most of the rest is still small mom-and-pop shops and wet markets, but it's changing very rapidly. And yet, foreigners have been kept out by regulation. So most of that, most of that modernization is on the part of Indian conglomerates who are very cash-rich and have invested in building Indian retail chains. And even they have faced problems from the 20 million small shopkeepers who don't like the competition from them. So for example, there's a company called Reliance, which made its money in energy and telecoms, and they have decided to build from scratch a modern retail chain. Their initial plan was to build 5,000 hypermarkets across India. And then as they started to roll out hypermarkets, local merchants would come and trash them and protest against them. So they decided maybe better to stay under the radar screen. So they decided rather than 5,000 hypermarkets, they would build 500 hypermarkets, and then maybe 500 clothing stores, 500 convenience stores, 500 furniture stores, and so on. So they're building a lot of stores, but they're doing it in a way that doesn't attract as much attention as before. And that seems to be the way to go in India. And the government would like to reform the market, would like to allow liberalization, more foreign investment, because this would help to reduce the wastage in the supply chain, which is substantial. It would improve productivity in the supply chain in general. It would enhance the purchasing power of consumers by lowering prices, and it would boost hygiene, which is very important in the food chain in India. But so far, the government has had difficulty in getting the kinds of reforms that it wants because it's a coalition government. And as we here in the United States know, even when you don't have a coalition government, it's hard to get things done. So some of the issues for retailing, it's very fragmented. There's a very poor infrastructure right now for distribution. There's a lack of a national market, just like in China, really. There are different languages, different cultures, and different regulatory environments in different states in India, many regulatory hurdles. So even if companies do have the opportunity to roll out in a big way in India, it's going to be a very challenging market in which to operate. India is today, in a sense, where China was 20 years ago. But 20 years ago, a lot of good things started to happen in China, and I think that's possible in India as well. And finally, let me talk about a couple of other emerging markets that no one's talking about, or not talking about that much, which I think will be important in the coming years. Because again, I think a disproportionate share of global retail spending growth will take place in the emerging markets, and we'll see them emerge as important economic powers with a rising middle class. So let's quickly go through a couple of them. Brazil is taking off. Their economy is doing very well. They already have a very modern retail industry that's open to foreign investment, where most of the foreign investment has been in food and mass merchandise. And now we're starting to see more non-food retailing invest in Brazil and consolidate it. One of the interesting things about Brazil is that unlike other fast-growing economies, income distribution is getting better rather than worse. And we've seen already in the past decade a large number of poor people move into the middle class. It used to be in Brazil that you had a lot of poor people and a few rich people and not much in between. And now, for the first time in their history, about half the population can be considered middle class. That's very good from a retail perspective. Middle class people really drive the need for modern retailing because of their shopping behavior, the amount of time they spend shopping, the amount they spend on each shopping trip. So the outlook for retail in Brazil is actually quite good. Then there's Russia, which is an economy with an income similar to that of Brazil, that had a very deep recession during the global slowdown, but now is growing rapidly due to the rebound in energy prices. But that's a little bit of a problem for them in that they're too dependent on energy exports, and if energy prices were to fall again, they'd be in trouble. Moreover, they haven't done a good job of encouraging investment in other industries, although they have been very open to foreign investment in retail, and foreign retailers who have gone there have, for the most part, done reasonably well. So the big question in Russia is who's in charge? Because Mr. Putin keeps talking about the need for state control, and he has a very statist, old communist mentality, whereas Medvedev, the president, has been talking about the need to open the economy, diversify it, focus on education and innovation and more transparent markets. And that raises some questions, because I always thought that Putin was in control and Medvedev was simply his puppet. And now Medvedev is saying what he really thinks. So either Medvedev really truly has an independent power base, or he's crazy and will soon be arrested. So we'll have to wait and see what happens. Then there's Indonesia, which is often called the fifth brick, because it's a very big economy that's growing very nicely. They had a big crisis at the end of the 1990s, and that kind of slowed things down from a retail perspective. We had seen Walmart and JCPenney go in there, but they had a bad experience and left. And yet Carrefour has done quite well there. I would consider Indonesia a place with a lot of low-hanging fruit. It's a poor country, but with good economic growth. It has become more politically stable than it used to be, and it's fairly open to global retail investment. So I'm fairly optimistic about the prospects for Indonesia. But for there, most of the opportunity lies in food and mass merchandise retailing, to a lesser extent, non-food and luxury. Vietnam is an interesting place. It's kind of where China was 20 years ago. Very poor, 90 million people, but growing very rapidly with a very fragmented retail industry. In Saigon or Ho Chi Minh City, there are 2,000 wet markets and 6,000 independent retailers. Very, very fragmented, and yet the largest chain in the country has only 70 stores. So there's some real low-hanging fruit there. There's an opportunity. There's some uncertainty, too, as to whether the government will go in the same direction that China went 20 years ago. Already the government last year imposed price controls, which is not very market-oriented. So there's a bit of a question mark about Vietnam, but the potential there is huge. South Africa also is attracting a lot of attention lately. Walmart has just decided to go in there and potentially use that as a springboard to investment in other African countries. Why is Africa suddenly of interest? Well, because it's growing for the first time in 50 years. It's instructive to recall that in 1960, Kenya had a per capita income similar to that of South Korea at that time. They were both poor countries. South Korea is a rich country today. Kenya remains a poor country. So for 50 years, Africa didn't grow very much. But in the last 5 years, they've been growing, largely because of the attractiveness of their commodities that the Chinese want. The increase in commodity prices has fueled economic growth in those countries. And so there's a possibility that this could be the next frontier, that this could be a place where there are some opportunities in some of the countries within the African continent. And certainly South Africa itself already has a fairly sophisticated and modern retail environment. Colombia is of interest because for a long time nobody wanted to go there because of the drug wars. It was dangerous. The government defeated the drug lords, and now it's a relatively safe place. You can go to Bogota and Medellin and not worry about getting kidnapped. And that's very important if you're a retail executive looking to invest. So this is an economy that's now growing at a good pace. It has a growing modern retail environment with companies like Carrefour and Casino and Falabella from Chile investing there. So Colombia is also a place that's now on the radar screen. Egypt was on the radar screen until the recent revolution, and it may still be. In the last 3 years, Egypt actually had very strong economic growth because of very good economic policies that were largely the result of Mubarak's son, who had hoped to become the next president. That's not going to happen now. But in any event, part of the problem is that that sudden spurt of economic growth, the benefits of that growth accrued to the privileged. And everybody else could see that growth and not experience it, and that bred resentment, which I think contributed to the revolution. In fact, if you look at where revolutions take place, it's never where things are bad, it's when things are good. It's when people become resentful of the changes that take place, that leads to revolution. And that's what happened in Egypt. And now we're waiting to see which way Egypt goes. It could go the way of Iran, and that would be a problem. Or it could go the way of Turkey and become a stable democracy with good economic policies and a rising middle class, in which case Egypt would be a very attractive place for retailers to invest. So at this point, we just don't know. And then finally, Turkey, which is a very attractive place with a modern retail industry, with very sophisticated retailers who are already investing outside of Turkey in other markets in the region, in the Middle East and in Central Asia. And they have a strong fashion industry in Turkey as well. And they have very close economic ties to Europe, although they're not likely to become part of the European Union anytime soon, but their relationship with Europe benefits their economy and enables them to have the strong economic growth that they do now. So we're seeing a lot of global retailers take an interest in Turkey because of this. So I'd like to finish up with something we do in our Global Powers of Retail report. You may have seen the report where we list the 250 largest retailers in the world ranked by revenue. And it's an interesting list, and if you're high up on the list, it means you must have done something well at some time to become so big. But it doesn't really say whether or not you're well positioned for the future. And we try to measure that by looking at something called the Q ratio, which is the ratio, and we can only do this for publicly traded companies, it's the ratio of a company's market value to the value of its assets. And the idea is that in the current business environment, what retailers really are challenged by is commoditization. Consumers going online, getting all the information they need, and shopping where the prices are lowest. Where consumer attitudes seem to be, quality is the same almost everywhere, so I'm going to shop on the basis of price. And that destroys brands. So the challenge for retailers is to be sufficiently differentiated from competitors that they impress consumers, to manage their brand name sufficiently well that consumers understand who they are and what they do, to offer consumers a superior customer experience in the store or online. Those are non-tangible assets. So if the Q ratio, again, the ratio of the market value to the value of tangible assets, if that Q ratio is very high, it means the financial markets are saying that a large part of the value of a company comes from its non-tangible assets, such as brand. And all other things being equal, that should be good. That should put a company in a position where it's going to do well in the future. So we ranked the publicly traded companies on our list by Q ratio, and here's what we got. These are the top 30. There are obviously many others. Number one, H&M. They've been number one on our list every year that we've done this, and obviously they have a very strong brand identity. With a Q ratio of 7.85, that means 7.85, it means that their market value is 7.85 times the value of their tangible assets. It means most of the value of the company in the eyes of shareholders, in the eyes of the financial markets, comes from their brand equity and their differentiation. Other companies on the list, BİM, which is a hard discount retailer in Turkey that's very popular, Coach, Amazon, Apple, all companies that either have a strong brand, are clearly differentiated, or have a really superior customer experience. I actually gave this presentation in Turkey, and when I pointed out that a Turkish retailer was number 2 on the list, I got a standing ovation. So that was a really enjoyable thing. So those are my thoughts about the economy and the global retailing industry, and I'd be happy to take your questions. Thank you. Well, I can't really see, but I see a hand here. Okay, wait for the mic.
Thanks, Ira. Fascinating as always. The Q ratio discussion you just sort of concluded with, can you draw any generalizations about what are the traits of companies that are high on that list versus others that are lower on that list?
Okay. I think the companies that are high on the Q ratio list have one or more of the following attributes. They have a very strong brand name. They are clearly differentiated from their competitors, so consumers won't look at them as being the same as someone else and then just shop on the basis of price. They often offer a very superior customer experience. Sometimes they have the first mover advantage. They were the first to do something very innovative. And then if we look at the companies on the bottom of the list, which I didn't show because I didn't want to be impolite, but many of the companies on the bottom of the list are Japanese department stores. Which are not terribly good merchants. They do most of their stuff on consignment. They're clearly not differentiated from one another. They don't have strong brand identity. Many of those companies have a Q ratio less than 1, which means actually that there's an arbitrage opportunity. It means you could buy the assets I mean, you could buy the company in the stock market and then just sell off the tangible assets and make a profit. So those are companies that, in a sense, are destroying brand equity. So those are essentially the differences. Yes, over here.
Yes. Do you feel like all these countries, these emerging countries that you spoke about, the educational level of those young people that are creating that middle class, do you think that's a major factor in creating this growth? They're educated, they know what they want, they have bigger dreams and goals than their parents?
Sometimes that plays a role. There are many, many things that contribute to whether a company grows rapidly or not. One is demographics, if the demographics are favorable. One is certainly economic policy in the country, whether they've controlled inflation, whether they control government debt, whether they are open to foreign investment. Education does matter as well. It enables, more education enables people to move up the value chain. Not necessarily very highly educated. The highest unemployment rate in Egypt is among the college educated, actually. So there are no jobs for them. The jobs are more at a lower to middle level. One of the things that really makes a big difference, especially in poorer countries trying to move into the middle class, is whether they educate girls. If they have a very low level of education for girls who then don't participate in the workforce, that tends to retard economic growth as well as retard human rights. And I think one of the big questions going forward, if you look at the countries that have really good demographics, like India, the Middle East, and Africa, I think the only one of them right now that's growing rapidly is India, because they're rapidly moving girls through schools and into the workforce. So the female participation in the labor force is increasing dramatically. That's not the case in the Middle East. And that's one of the things that I think has held back the non-oil producing countries in the Middle East. If they were to change that and focus more on female education, I think that could have a huge impact on their economic growth. Other questions?
Yes.
Over here.
Good morning, Ira.
Good morning.
On your first slide, you mentioned about the U.S. being very important to start exporting, and that's the future for economy. Some retailers like Crate and Barrel have opened stores in Canada, Dubai. Others have developed strategies like Macy's that they don't have stores abroad, but they have a tourism department to not take the product down to other countries, but bring the shoppers here to buy from them. Are there any right or wrong strategies from retailers about entering the global market, either by just staying here and bringing shoppers or going outside overseas?
I didn't hear you very well. I think the question is about rules of thumb for going into new markets? Is that?
Yes, either a strategy to open stores in other countries or develop your bring shoppers to buy from you from other countries.
That's a very good question, and something I've looked at a lot over the past years, and to see whether or not there is some rule of thumb was what's the best way to go into a new market and what is more successful than other strategies. And the bottom line is that there's no rule of thumb. Unfortunately, because if you look at the experience, there's a vast experience of retailers from one market going into another, and you can look at cases of a particular strategy where it succeeded and cases where it didn't. Maybe the devil is in the details. Maybe it depends on execution. And maybe it depends on the particular circumstances of a retailer. I think the first question to ask is, what is it you're bringing to the table when you go into a new market? Is it your format? Is it your merchandise? Is it your supply chain management? Or is it just you have lots of cash in the bank and you can afford to make mistakes and try new things till you get it right? You have to figure out what it is you bring to the table. And there are lots of examples. To me, one of the greatest examples is when Starbucks decided to go to Japan. The question is, do they do what they actually did in the US, or did they change it to try to accommodate the different tastes of the Japanese consumer? And they were told by a consultant, not us, not to go into Japan because the Japanese drink tea, not coffee. They're smokers. They will not agree to not smoke in a Starbucks store, which is one of the rules in Starbucks. They will not walk around the street with a styrofoam cup or put it on their desk at work. Coffee shops are not for Japan. So Starbucks said thank you very much and proceeded to go into Japan with the same exact format they have in the US, and it was hugely successful when they first went in. Apparently they were able to change the culture and appeal to young people who wanted a place to hang out other than a bar. And they provided that. So you never really know. And of course there are other examples where a retailer went in and did what they normally do and it didn't work, like when Walmart went to Brazil and didn't have a large enough parking area because they didn't realize that in Brazil, people who go to the hypermarkets only go on the weekends. The rest of the week, they don't do much at all because they're at work. And most families, even with two incomes, only have one car. So you need a huge parking structure and you need very wide aisles in the store because everybody comes on Saturday. And Walmart didn't recognize that and had to spend a lot of money changing to accommodate that different kind of culture. So again, no rule of thumb.
Ira?
Yes.
As far as American designers and American specialty brands, given all of your emerging markets, which one do you think would be the best market for an American brand or specialty retailer to look at seriously, given the state of everything that you've shared?
Fashion brands, you said?
American designers or American specialty retail brands?
Well, it depends on the market position of a particular brand and depends where there might be some low-hanging fruit. I think that Chinese consumers especially like American brands. Even though most of their upscale fashion spending right now is on European brands, I think they're very open to American brands. It's something new and different for them. It's interesting, if you go to supermarkets in China, you find that they like ginseng. They eat a lot of ginseng, or use a lot of ginseng. And the ginseng that's most popular is the one that has an American flag on the box. Apparently, they really like American brands. So I think China is a very attractive place from that perspective. I think India is too, because India has a huge diaspora of people, some of whom live in the United States, and there's a lot of travel and communication. So Indians are very aware of American brands. So, but I wouldn't limit it to that. I think a lot of emerging markets, even when people criticize the U.S. government, they still like U.S. culture. And I think that will continue.
Ira, I have a question over here.
Okay, I don't know where you are, but
I'm
just go
to
ahead.
your left.
Okay.
And so to continue that line of thought, if we just take India and China, where you have high status consciousness, which means value to the American brand, but strong price pressure, it appears that counterfeit market is how those two are reconciled in both countries. So can you speak to where that might be going, or insofar as regulatory pressures around that? Because I would think that that has a big factor as to whether or not that consumer will buy branded true goods as opposed to counterfeited goods.
Yeah, well, obviously, pirating is a huge problem in these countries. And the governments, certainly the government in China has not done enough about it. They've given lip service to it. Every now and then they crack down on someone. But there's a lot of piracy. Now, some brands may feel that the existence of the pirate market is to some extent helpful in developing the brand awareness. But then there's a cost to pay for that. So I can't say there's going to be any good news on that, except that as China moves up the value chain and moves away from just being an offshore manufacturer of products for other global brands and wants to start to develop their own brands in a bigger way, including brands that they might be able to export to the rest of the world, at that point, I think there'll be a very strong demand for the Chinese government to do something about that. So I think in time, I think the issue will be addressed, but for now, it's a very challenging problem. Okay, I'm probably out of time. Is that correct? All right, thank you very much.